Hi guys, welcome to the fifth lecture of this series. Today is the last lecture and we had a great experience. So let's wait for a couple of minutes for everyone to join. We are also waiting for our instructor. I think yes.
Hi Mohit, hi Prayank.
Anand.
Hey guys.
Guys, while we wait for Ritesh, any feedback, anything else you want us to cover maybe later on whenever we get the time? I do want to take a break because this is extending. This is the last week and this is the last week of lockdown. So if we extend the program, I'm afraid that the lockdown will also get extended. So I think we should take a break for now.
Are you seriously considering to extend? I thought we covered a lot of things.
No, we covered it. I'm just asking if people feel that something got left over.
I think, since we have all young venture capitalists here, and we have discussed a lot of things which are, in my mind, not actually, they are good things to have, but how do you guide companies and advise companies and help them build significantly, right? So, making a term sheet, doing valuations, doing the building thesis is all great. It makes you this is all theoretical work, but actually, Ritesh, we are covering what else we should have covered in the course. I was just saying that how do you advise a good company? How do you gain the trust of the founders, and how do you make the company become big? That is something which we have never discussed, right? And I think that is actually the core job. This is negotiating term sheets is not the core job. So, but anyways, that's.
I think we have to leave some for experience and self learning also.
That's true.
But it'll also come from reading a lot of people. Reading is a very helpful thing.
Yeah.
Also talking to other VCs, that's very helpful, Prayank. I always talk to people whenever I get a chance about how they are thinking, what they are doing. That's very helpful in that.
Today itself, I had conversations with 2-3 other VCs and asked them for advice as to how they navigate certain situations, and not just in my fund, outside.
Yeah.
Because, come what may, Indian VC industry is still very young, and all of us are learning to be better versions of VCs.
No, and the good part, Prayank, is that I had 3 partners from very, very large funds calling me on the other way around. How are your companies? Because I want to learn, right? I was really flabbergasted.
I'll call you after this call.
Yeah, of course.
Okay, cool.
So, carry on. Let's start. Ritesh is here.
Yeah.
Yes. Hi everyone. Hi Anand. Hi Prayank and everyone else. Good to be here yet again. And actually, I'm a little sad that it's ending today. I don't know about you guys. I personally really enjoyed.
Yeah, this has gone on as long as the lockdown. So.
That's true. Actually, our last thing is just before the lockdown ends.
Yeah.
Hopefully it ends.
Hopefully it ends. Yes.
The lockdown. Great. So let me share my screen. One second. Can everyone see?
Yes.
Okay, so today Prayank and I have prepared an interactive session on term sheets. There's a fairly long agenda. I don't know if we'll be able to cover everything, but whatever we are able to cover, we will try to. And yet again, please do ask your questions. Let's keep it interactive as much as possible. Otherwise, it feels like we're talking to a wall. So we'll start with the broad, guiding principles of what is a term sheet. Why do we issue? a term sheet? How should we think about economics and control? Is there a trade-off between economics and control between term sheets? Then we'll go into a number of practical considerations that are listed here. And we'll try to end with how to approach the negotiation itself, because it's not just the contents of the term sheet, it's also how you negotiate it that becomes quite important. So let's maybe start off with term sheet basics itself. So I think the first thing I wanted to talk about is, why do we have a term sheet? Because in most kind of negotiations or contracts, you sign one contract and you're done with it. You don't actually sign a quasi contract first and then you sign another real contract. The difference in venture investments, though, is that there is a significant investment from both sides. From the founder, there is the investment you make in actually evaluating the company. You spend time, doing legal and financial diligence, doing the docs, and so on. From the company side, there's probably an even bigger investment in terms of both locking themselves to one fund, and there is the time and energy investment in the diligence and docs process, and which is why both parties usually agree to a certain set of terms upfront, and getting an early agreement on those terms actually helps smoothen the relationship later. I do want to spend some time on the legal implications of term sheets versus conventions of term sheets. So legally speaking, term sheets, at least in India, are mostly non-binding, except for a certain set of clauses, typically confidentiality, exclusivity, and expenses are the only set of clauses that is legally binding. Everything else is just serves as a basis of discussion. That's just the legal aspect of it. In reality, though, there are very strong conventions which differ from industry to industry and which differ from company to company as well. In Indian venture capital, the convention is quite strong that unless there is something that you discover after term sheets are signed that you did not know before, which is material, you actually honor your commitment and wire the money. In my entire career in venture capital, there have only been 2 term sheets that I've walked out of. In one, we actually discovered that the founders had lied about the amount of revenue they were making. So that was quite straightforward. We actually, when we dug into their books, we found that the revenue was roughly 25% lower than what they had told us. So we walked away from that term sheet. That was in the very beginning of my career. About 5-6 years ago, I walked out of another term sheet, which is when the founders started to renegotiate with us based on a verbal offer they had gotten from somewhere else. This was after they had signed the term sheet. And that was more as a matter of principle, to be honest, than anything we discovered at that point. At least I do expect a handshake to mean something. And if we are keeping our part of the bargain, we would expect the founders also to keep their part of the bargain. That said, there are certain considerations. I was speaking with another VC just last week who was having cash flow issues of their own. So they decided to share those issues, cash flow issues, with the founders that they were investing in, and they mutually agreed to cancel the term sheet. Sometimes, once again, an event like what has happened in the last 2 months could classify as a force majeure, not only legally but also in reality, and might. I mean, I would not hold it against a VC if they decide to pull out because of this. But in general, the expectation is that you would neither renegotiate the terms nor pull out after you have signed the term sheet unless some new material information comes to light. Actually, I'll tell you another story there. One of my ex-colleagues, who was more senior than me, made me learn that lesson very, very nicely. There was a company which was an existing portfolio company of ours, where we had a non-binding but signed agreement to give them, which is a term sheet, to give them another tranche. It was about 1 crore at a certain point in time, which was unconditional, but it was not binding. The company was not doing well. And in our partner meeting, several of us pushed back that, hey, if we don't have a binding agreement, let's not give them that additional 1 crore. And what the gentleman asked us in that meeting was, are you going to destroy your reputation for 1 crore? That has indeed stayed with us, that a commitment is a commitment, and we must honor it. The next thing that I would like to talk about, and this is a little controversial in our industry, is that there is this massive stigma against shopping term sheets. There are funds that I know who don't even give written term sheets. They will send an email as an offer. There are funds that will give a term sheet without the name of the, till they are ready to sign, without the name of the fund written on top. There are funds that will, not take very kindly to shopping around. At least my experience is that exclusivity is just there on paper. You cannot do anything if a founder decides to shop around. And if a founder, after signing a term sheet with a VC, decides to shop around, it also means that they were not happy with the original deal that they signed with you. And so the mental model that I operate with is that there is no real exclusivity. You have signed an exclusivity, but it is not worth the paper it is printed on. It is important to continue to strengthen the relationship. It is important to continue to sell to the founder as to why they should partner with you, as opposed to go outside, even after the term sheet is signed. I would not take exclusivity for granted at all. Not just in India because of the weak legal system, but in general, I think that if we are relying on contract to enforce the relationship, it's a very poor start to the relationship. Another area that where I have a relatively strong opinion is that one should not use standard term sheet as an excuse. If we cannot get the founder to understand and agree with our point of view on why that is and if we can't negotiate in good faith with the founder, I think enforcing a term just because it is a standard, to me is, I'll go out on a limb and say it's a bad faith negotiation, because that means that we cannot explain our point of view to the other party and expect them to agree because that is what we have signed with everyone else as well. So one best practice I would actually recommend is, while negotiating a term sheet, to not give this argument that this is a standard clause that everyone in the industry signs. To me, that's the sign of a weak argument. One last point here about the length of term sheets. To me, there is no standard length. I personally prefer short term sheets because they are a signal of trust. It's a signal that to both parties that we are willing to trust the other party to not walk over us, walk all over us when it is time to negotiate the final agreements, when it's time to negotiate the finer details. This is actually a bigger issue for founders than it is for investors. Investors, I think, will always prefer short-term sheets because we have the power in that, in the final negotiation. The company might have wasted 2 more months or 3 more months by that time and is more likely to agree. I think of it as a signal of the strength of the relationship, that if a founder is okay with a shorter term sheet, that means that they have trust in us, and then it is incumbent upon us to not break that trust. Um, very often we will start with a 2-page term sheet, and if the founder then asks for details to be negotiated, then we'll write a longer term sheet. That said, most of the actual term sheets that we sign are 4 pages, 5 pages, because it is a little rare in India for founders to trust VCs as much to sign a short term sheet. Before we move on, any comments, Prayank, on these?
Yeah, I think there have been so just two instances which come to my mind when I want to talk about term sheets. So one was the instance where Accel, along the smaller fund, in smaller terms of size, was gave a joint term sheet to a company, and we had to walk away from that term sheet because the startup was not honoring or trusting the smaller fund as much. And we felt that just the fact that the other fund, like for example, they were saying we will not give board observer rights to the smaller fund, forget about director rights, or they were saying that we will not give super pro rata rights to the other fund, even when the other fund was saying, hey, I really like you guys, I know you came first to Accel, but I would like to increase my ownership. And we sat down and we had probably like 4 or 5 separate meetings explaining to them the merits, demerits of that. And we felt that, at least I felt that, the team was not being understanding, and they were actually, the bigger problem was they were not respecting the other fund. And I think that, so that the way they negotiated on the term sheet, so that it made us suggest to the smaller fund that we should walk away from the term sheet. And even though the smaller fund was, we said, hey, this is what we feel, and then they concurred that yes, they also felt the same way. So then we had to pass on that particular investment, right? So it goes both ways. We are respecting the entrepreneurs and the how you negotiate that. We actually observe how entrepreneurs negotiate the term sheets. So that is one instance. And I think uh, the the other instance was actually, this is where what we discussed between me and me, Anand, and Ritesh. We were discussing whether we should have somebody from the legal fraternity as well, present in this presentation to explain the legalities better. I'm not a very good legal expert. In one of the term sheet negotiations, was what happened was the founders, obviously because of mistrust, they hired a very reputed lawyer, and we ended up negotiating the term sheets for like 2 months, because I think the that particular person, the lawyer, was negotiating. I'm talking about negotiating a term sheet for 2 months, not even definitive agreements, right? So, and during that process, the competition of that particular company raised one more round. Another fund which was with us, they got scared because the round the competing company raised was very extremely large. Like, we were giving like 2-3 million to our company, and the other company not only raised a 2 million round, but also went on to raise another 10 million in a Series B in a span of those 2 months. And the other fund developed cold feet. And that left us in the situation where we said, hey, Accel gave you the term sheet, we'll honor the term sheet, and not in fact, we will actually get you another co-investor because it just makes sense. But it was nothing to do with the fact that, the terms which were signed were very close to the original terms. But I think the fact that there was a lawyer who was trying to be extremely creative and trying to show value in a term sheet negotiation, just delayed the process so much and created so much harm to the company. I still hold that particular person responsible to whatever shape or form the company is in today. Um,
So great point, Prank. We also evaluate the behavior of the founder both during term sheet and during final agreement, right? And we have a clear rule that we'll watch the behavior, and that actually, while of course it's a shake of hands and all that, but in negotiation, actually, if you find out something additional about the founder, particularly about nickel and dime, particularly about not having a mentality of speed and all of that, and in some cases too much of self-interest, where founders don't want things like vesting, etc. In those things, we have, instead of saying negotiating and prolonging it, nowadays we are basically saying we'll walk away, because we have a newer information, we can't ignore it about the founder.
Yeah.
In fact, to that extent, it's actually much better if all the decision makers are personally involved in the term sheet negotiation at least. It's very helpful.
Yeah, that's a very good point. So one thing which we've realized, one thing which in the recently we've started doing is whenever we issue term sheet, and after the term sheet has gone, 1 week later, we ask all the lawyers, we ask all the investors to come sit together in one room, if or at least on a Zoom call or online call. Everybody has to be there for 2 to 3 hours, where we sort out all the key issues between all the decision makers, so that the speed of the process at which it can be signed goes much faster.
Yeah.
Any questions?
Ritesh, I have one comment to make. Madhukar here. Hello.
Yeah, go ahead, Madhukar.
Yeah. So with respect to the commitment, and if we have given a commitment, and even if it is not non-binding, the investors should give money. I think this message, which is too often discussed in the VC community, leads to a feeling of entitlement among the entrepreneurs, right? So although the commitment from an investor side, if it is completely binding and written in the agreement that we will give you money respect to that, then you don't need to walk away from that. But if there is a non-binding commitment, which is basically a tranche based on what happens next, right? I think as an investor, we have to basically keep the founders and the team, and especially our team should convey to the founders that this money is, we are a manager of this money, and if we find that this money is going to be good money after bad money, we will not give you this money, right? So I think this message is also important to be conveyed to the founders, because what I have seen is that if something is signed, and even if it is based on certain conditions, entrepreneurs think that this is their entitlement, right? And if the VC is not giving, or basically saying that you do this, then we'll give you, they consider it as a breach of commitment, which is not necessarily, because if it is not, because if it was the case, then in the agreement it would have been written that it's a binding commitment, right? If it is not, then it is not. So I think what I'm trying to convey is that it is not that easy to give the money, even if you see that the company is not doing well and it is going down the drain, and I'm not obliged to just for the sake of reputation. I understand I think there's an agency problem over there, because the shareholders, the fund which you are managing, they would want not to give money, and we as GPs, we would want to protect our reputation, therefore we want to give the money, right? So that is also a very important thing which needs to be conveyed to the founders, that we might not be able to give.
No, absolutely, Madhukar. So at least, I was planning to cover it a little bit later in the presentation as well. I'm personally not a huge fan of conditional term sheets or tranching based on some milestones, for precisely the reason that you're talking about. That even if it is not a signed commitment, it becomes an expectation in the founder's head. So for precisely this reason, I mean, in fact, I was discussing with Anand the other day that I personally don't even like to give verbal assurances to founders of the kind that I see very often in the VC world. That don't worry, we will not let you die. Don't worry, we will take care of you. Because even those small throwaway lines actually create an expectation in the founder's head. So at least in my mind, the important thing is to, when we make a commitment, we should be sure of the commitment that we are making. And if at that point someone were asking us to sign a binding commitment, we should still be ready to make it. Until then, we shouldn't make it. Is my way of thinking. And I'm certainly not a big fan at all of conditional commitments, because then even if then there is no black and white. Because the founder says, I have reached 95% of what I had committed to you, it should still come to me. Whereas the black and white says that if it's 95%, you don't get it.
99% of the times we just simply avoid things like tranches, things like commitments, verbal. In fact, by and large now partners say, dude, I don't know about the bridge round. I don't know about the next round. I don't know about my pro rata also. Let me get back from the investment committee. And I think now by and large, everything goes into the investment committee, right?
Absolutely. I think that clarity is very important.
Yeah. It's an important thing to learn, because you don't want to unnecessarily give a commitment which the founder will hold against you. And trans deals are anyways not necessarily now. Historically, they haven't done very well for us, right? For practically, I think that's the case for all of us.
Yeah.
The moment you think like about tranching, that basically means that you don't have full faith and you shouldn't be doing the deal, right? That's what it's
absolutely.
Okay.
I think someone has put something on chat. Okay, Vikram has asked a question on tranching. Just give us a few minutes to cover that. I'll just go back to the, Prayank, all yours.
Yeah, so very early on, I think one of my partners, Mahindran, when I was trying to understand term sheets, taught me about this, that every term sheet you should think in terms of economics and control. And I think I find that as a very helpful framework to understand about term sheet. So if you look, there are certain clauses in the term sheet which define the price, which define how money will be made at time of exit. It defines how founders will make money, investors will make money, employees will make money. And these are the clauses like price, Ritesh will talk about dilution. I'll talk about a little bit. There's some warrants, liquidation preferences we'll talk about. There are certain term sheets, certain clauses like to play, which a lot of people will not have seen in India, non-standard, but at times of desperate fundraisers, they become active. And you start seeing some of those. Or if you are raising money from some esoteric VCs, you will see those clauses. And then obviously there's the big significant part, which is the control, which is board of directors, protective provisions, agreements on who can sell when, what happens if somebody else sells, those kind of things, right? So the interesting bit is, I don't know how many of you know that VC sign off, VCs get preferred equity, right? So preferred equity is equity which has all these special rights of control, which is different from common equity. So most of the time, angels, majority of 99% of the time, angels, employees as well as founders will have common equity, and investors will sign up for preferred equity. There has been one case where I've seen even angels having preferred equity, and a lot of issues can get created. Wherever I've seen angels getting preferred equity, issues have always got created by the way. So that's the difference between economics and control. And specifically, I think even though we are all minority investors, right? So in PE world, people take majority control of the company. VCs take minority control, but since we have preferred equity, we are able to exert a lot more influence than the equity. Even though we might have less than 51% share of the company, we are going to talk about a few of actually control. We are not talking too much about it, but it will be things like for any change of business by the company, they should take permission from the investors. For issuing any new debt, they have to take permission from the investors. And when I say permission from the investors, that's also a very interesting concept. Do you take permission from each and every one? Do you take a majority? How do you take it? At least at Accel, what we have done is we take it from majority of preferred shareholders, and there is no shareholder has a veto on the particular provision, right? So, and that's very I thought it was unique to us. I'm hoping it's changing in the industry now. we have learned about it over a few years where, for example, exit in one of our companies was prevented by another shareholder who had a veto. I mean, because everybody had a veto, he vetoed that particular exit. And it was beneficial for everybody, but it's just that, either that investor didn't like that terms, or he was getting less money, he wanted much more capital, or he just had some fight with the founder and he just didn't get. So since then we have a majority of investors, and so that's also, so control not only comes in what is written, but how it is executed is by actually the voting rights. So that's the broad concept. Yeah. Ritesh, you can go next slide. Yeah.
So let's talk about.
Any questions on the previous slide? I forgot to ask that. Yeah. Okay. Cool.
Let's talk about valuation, which I personally consider the ultimate vanity metric. I think the first thing for me, which it took me an embarrassingly long time to learn, is that valuation is not what the company is worth. To me, it is not the price of your company, because nobody is buying your company for that amount of money. There is no transaction for the entire company. Let's take a typical Series A valuation in India around $10 million. Nobody will pay $10 million to buy a typical Series A company in India. And so the fact that many founders and sometimes investors also attach their self-worth to the valuation of their companies or to their portfolio companies, to me, it is absurd. A valuation, in my mind, is a mathematically derived figure. What matters, the only thing that matters in funding rounds is actually the shareholding that you're getting. And you back calculate the worth of the company on the shareholding. All that a transaction says is that so much percentage of your company is worth so much. That doesn't actually mean that if 15% of your company is worth $1.5 million, that doesn't mean that your entire company is worth $10 million. And that's something that I repeatedly hammer into my own head and into the heads of the founders that I work with. So as investors, my very strong advice is to focus on the shareholding. That is what matters. The rules of thumb that we sometimes have, that for a Series A company, we will pay only so much. For a Series B, let me actually give you an example. I'll also reveal the name of the company here. In 2008, I had evaluated InMobi for their seed round investment or Series A round investment. We made them an offer. We actually gave them a term sheet. Our term sheet, I think, started at around $6.5 million. After a couple of rounds of negotiation, we were willing to go all the way up to $10 million. They got a term sheet from KPCB for $17 million pre-money. And my partners and I were laughing at that term sheet. They're crazy. Who gives a Series A term sheet in India for $17 million pre? Even today, this is 12 years ago, but even today, that's a little bit of a high price. I think it's still a little bit of a crazy price. And we were laughing at that fact that, this Firang investor is overpaying. The fact is, we had completely missed the wood for the trees. What we had not understood is that it is not the $17 million. It is the shareholding that we were getting. They took a slightly larger risk by giving a larger amount as well than what we were prepared to offer. But the point is, we became fixated on the valuation number, which had no bearing at all. What we needed to think about was how large will this company become, or how large can this company become, and can I have a meaningful enough shareholding in this company to get a large exit from my fund? Instead of that, the focus became the valuation, which is why I think it is one of the biggest regrets of my investing career, because we liked everything else about the company. We lost it on valuation and felt good about losing it on valuation. So my, not to say that one should always overpay, absolutely not, but just that particular metric of valuation is the wrong metric to focus on. I would focus on shareholding as one metric, and which basically gives you an idea of the upside, and amount exposed as the other metric, which gives you an idea of the downside. Valuation is a product of the two that actually doesn't matter at all. One small point here, that valuation matters even less in follow-on investments. Because it works both ways. The value of as the valuation goes higher, the value of your existing stake keeps increasing. The value of your new stake, of course, what you get in return for your new dollars keep reducing. And I'll leave it as a mathematical exercise for the group to figure out at which point are you indifferent to the valuation. There exists such a point where you are actually indifferent to the valuation that you do on your own DAT if you're an existing investor. But suffice it to say that as you keep putting more money into the company, the subsequent round valuation actually matters less and less to you. So how to think about valuations? This is how I like to think about it, that one should back into a valuation number or a stake number, and by consequence the valuation number. What I mean by back into is assess the risk and the return. Like I mentioned, the way to assess the potential return is to see what kind of shareholding do you need to make a meaningful return for your fund in that kind of company. So let's take a highly risky concern, let's say a content company where monetization is also not clear. How large it will become, how it will compete with the Facebook is not clear. So the stake that you need in a company like this, which will be highly dilutive to get to your target overall return in the fund, might be higher than the stake you need in, let's say, a consumer brand that might not be as dilutive, and that might not require as much capital. So I would back into the valuation based on the future value of your stake, as opposed to rules of thumb about this is how much we pay for Series A and this is too expensive and so on. So the way we do it is we look at the potential exit value and then come back into how much stake do we need? Can we get that stake for the company, for the money that we are prepared to offer? The second part is the exposure. Like I mentioned, that is a risk, or that is a measure of the downside. How much exposure am I willing to take to this company at this stage of its evolution? How much money can I afford to lose? That gives you a sense of the downside. You multiply the two or whatever, divide one by the other, and you get your valuation. I think I've already made my point here, and maybe good time to address the question that had come. I personally do not believe in either contingent offers, which is that your valuation will be so much if you achieve this benchmark. Otherwise, the valuation will fall back into to this number. Let's say, if in the next year you achieve $5 million of revenue, this will be the valuation. If you don't, then this will be the valuation. I think that creates perverse incentives. It is very, very hard to structure a single metric or a set of simple metrics that will align incentives for everyone. So personally, I think they're very dangerous, contingent offers. Similarly, I feel or I believe that tranching especially for early stage companies is a bad idea, because effectively what you're telling the entrepreneur is that the valuation is fixed, but I will decide whether to give this money or not based on how much you've achieved. Um, and second, you create the kind of expectation that Madhukar was talking about when you tranche your investment. And if for whatever reason you do not give your next tranche, it is guaranteed to create bad blood. So at least I prefer not to do tranching at all in any of my investments. One last point, or maybe the second last point here, is that if you give a conditional term sheet, you should not expect exclusivity in return. There are investors, I have also made this mistake in the past, of giving a term sheet which is conditional, that if you are, I'll give you $2 million if you're able to find another investor for $2 million as well. I think it's okay to make that offer. It's also okay, I think, to make that, to give that term sheet. But then one should not expect exclusivity in return, because you are not yet making the commitment. And so it is not fair, I think, to expect that commitment from the entrepreneur either. I would probably still give, and sometimes one has to give a conditional term sheet that, hey, we are in, but we need someone else to come in along with us. But then it should be a non-exclusive term sheet. The last point I want to make here on valuation is convertible valuations. I personally think that convertibles should be done for intermediate rounds when it is not a large lead round. So whether it is whether it's a round that angels are leading when they don't have the ability to price a round and are waiting for an institutional investor to price the round. And second, in the case of, let's say, bridge rounds, where you are actually giving some money to the company to actually take them to the next round. Those to me are acceptable cases of convertibles. But it's important to watch out for incentives. Particularly, I worry about convertibles with caps. And very often in the US, people have convertibles with caps. We are seeing that in India as well. What that sometimes ends up doing is putting a ceiling to the actual valuation that the third party might offer in the company as well. If you're saying it's a note with a cap of $10 million and a 25% discount, often that means that the maximum valuation that the company will get will be $12.5 million. Is the math. So I would watch out for those kind of incentives in convertibles. Any comments, Anand, Prayank?
Yeah, I think I have found the bridge rounds and pricing the bridge rounds of convertibles extremely tricky. And whenever we issue term sheets on bridge rounds, it's and then to and fro happens that we will try to put a cap, and the founder will say this cap is too low, it should be higher, because either they are extremely confident of their own performance. Whenever I have tended towards giving higher caps, it has always not been well for the company. And that's why it's a very difficult topic, what cap to put in a convertible, specifically if it's an internal bridge, if it's a bridge round, right? So that's been, the cap is a very tricky issue. I don't have a good answer how to think about it. It's an estimate for the performance of the company in the future. And between now and then, there are so many things which can go either right or wrong. And yes, it's a very, and obviously the founders will push for the highest possible cap. So it's a very tricky situation to be in, for sure. Yeah.
Any other comments or questions?
I have a comment, Ritesh, again over here. I think in the bridge rounds, again, it's all about the expectation management of the founders, and it depends who is basically pushing this round towards a bridge. So there are certain instances where investors are saying that, okay, don't go to the market now. Why don't you take some money from me and then probably in 6 months time when we hit this milestone, we'll go and we'll be able to get a better investor and a better better valuation, so on and so forth. I think at that point of time, having uh, a cap which is slightly higher and letting the upside getting shared proportionately between the founder and the investor is fair. But if you are seeing that the company is not in a situation where it is going to get any money from the market, right, I think the right way is to tell the founder that this is more or less a price down. Right, I am probably giving you a little upside. So if I would do it today, I will probably do it at $8 million, but I'm giving you some opportunity for like 3-4 months, and I will give you another 30% upside which gets created from here. So instead of capping it at 8, I will put it at $10 million. So then at least it is very clear to the founder that this is more or less a price down plus some upside if I perform, right? And I think that is also, I think it is fair, at least in my mind, because at the end for my shareholders, because I am putting more money at risk, and it can be termed as a good money after a bad money. Therefore, the upside, most of it should come to the investor if the company is not able to find a investor in the market, right? So that's how we have largely, in fact, we also try to keep a clause, and again, this is about expectation management, where we say that this term sheet is for this bridge round is for 9 months, and in 9 months, if you're not able to find a buyer, find a next round investor, then I would rather want to invest at the last round investment, right? So I will not give you a floor which is higher than what it was in the previous round. I think that conversation is slightly tricky, and sometimes it looks like sometimes founders do talk here and there, and they are told that is really gravely unfair. But then if we explain to them that you got your opportunity, you did whatever you had to, and you have not been able to get the money from the market at the price you wanted, then that is the price, what the price is, and you can't do much about it, right? I think expectation management is very important, and transparent communication with the founders is important, so that the entitlement doesn't set in. Because when that sets in, then even though you are helping and you are giving a bridge and whatever cap you can put, you come out of that cap with a bad relationship, right? So it doesn't work that way.
In fact, what I've seen is doing any bridge round is just bad, simply because the founders typically tend to end up. I mean, it obviously is needed in desperate situations, but typically what I've seen is it sets a bad precedent with the same founder. Then he will expect the next time he's in soup that you give him another bridge, and sometimes founders try to take the easy way out. Why don't you guys only do let's just do an internal round, because they've experienced that a bridge has happened. The bridge was fairly easy. They didn't have to make any pitches. They didn't have to go to 20 investors, and they don't know the. So I think that's where the tricky part is, that when you are when you are doing an internal round or doing an internal bridge, how you handle it with the founder. I have not found a good way to manage it. Is how do you manage it with the founder so that he doesn't take the wrong message home? I think that's very difficult, and especially that the valuation which you said, after whatever you do, at the end of the day, the valuation is the signal which the founder will coalesce around his thoughts. Um, so that's the tricky bit.
Right. Uh, so I absolutely agree with the both of you, Madhukar and Prayank. I think one, it is a very hard conversation to have, because in the case of most bridges, actually the power equation is very much in favor of the investor as opposed to the founder. And I also think it is absolutely fair to keep the floor as the last round price. Because at that point you've given them the chance to go raise money from outside, and if they have not been able to, that means the market has spoken. So then the investor who has invested the money sets the price. My concern has been more on seed rounds that are done as investables, because there is no benchmark for the price before. And there I think sometimes caps as opposed to floors can set a price signal which can hurt the founders without necessarily helping the investors much. So personally, I'm not even a fan of unpriced seed rounds. If I'm writing a decent size check, I need to be able to set the price. But particularly I think companies that come out of US accelerators seem to have this expectation of a convertible seed round. And there I've always struggled with the cap.
Yeah, I don't get the Y Combinator, post Y Combinator 18 million cap or 20 million cap rounds. They are counterproductive for everybody, right? And definitely don't compensate the seed investor for the risk, but also don't necessarily work in the favor of for the entrepreneur as well.
Yeah. Any questions on valuation?
I like the $1 trillion tag.
Actually, what I meant was that you can put whatever in the valuation tag till someone is offering that that price. It's just a theoretical number.
Yeah, it is just a theoretical.
Ritesh, I had a question. What do you think about bridge rounds in the context of COVID? A lot of founders are looking to do those internal rounds, and there's not much surety on how and when external funding will come in.
So my view is not different from any other bridge round. I'm sorry, I could not hear who asked the question.
This is Abhinandini. Hi, Ritesh.
Hi. But I think my view is not different from any other bridge round. That the risk is disproportionately with the investor, and so the investor setting a convertible with a floor is absolutely fair. In fact, if anything, the floor might even go down below the last round price in the context of a company whose performance is falling. So I would not hesitate to keep a low number as the floor, but it's the cap that bothers me. If it is this kind of a COVID-related bridge, where you do expect the performance to come back relatively quickly, then I don't necessarily even see the reason to have a cap.
Yeah, Ritesh, what we are doing is we are doing either a uncapped round or we are doing a flat round at the last round of price. Either of the two cases, depending on the situation. But uncapped is actually important right now. You don't want to give away any signal.
Exactly.
Yeah, and so there I have a slight addition to what the point you guys made. So I just try to look at the performance of the company. So if it's a company is doing well, right, and then you're giving them money to continue the momentum, enable them for when go capture the market share aggressively, then having just an unpriced round or discount to the next round valuation because you're enabling them, that's fair. If a company is not doing well and you are giving them money, why are we doing a bridge round? So is that a bridge round to get the company sold? Is there what is it that you're doing, putting money in a company for? I think that becomes super critical, right? And if the company is not doing well, then why even do it at the last round valuation? It should be at a discount to the last round valuation, right? So, because then again, you put into enabling behavior that, hey, even though the company was doing well, like what is the fiduciary responsibility as investors, right? So yeah. The tricky part is companies which are showing signs of improvement, but what do you do there, right? So that's a tricky bit.
Yeah, Prayank, our rule is simple. If you don't feel like giving it a last round valuation, then don't give.
That's true.
I agree.
Yeah. Ideally not give. If the company is still not worth the last round of investment, then better stay away.
That's a very good rule of thumb. I agree with you that heuristic.
Yeah, in venture, nobody has ever made money by buying cheap.
Yeah. So I think
the
down
number one
round
lesson I've learned is that.
Yeah, I think down round just is a pack of cards. You are just just pushing it a little bit. Just don't want to do that.
So Prayank, actually, Madhukar here. There is one other aspect, which is the amount of capital the company has raised, right? So in certain scenarios, somebody has raised a very small amount of capital, and if they are going in the right direction, but they are running out of capital because of not being able to estimate the amount of capital required for scaling, right? So it might be a small pivot or something is working, right? In that scenario, you might want to give because the company, although has needs money very desperately, but if it actually goes to the market and does its song and dance, it will die before that, right? So therefore, Therefore, in those scenarios, you have to bridge those companies. So for us, it has never been the problem because we give such a small amount that most of the times the bridge is important because we are writing very small checks. But you are right, if the company is capitalized in the first instance for its business plan for 24 months, then in that scenario, probably bridge is a very remote discussion we should have, and probably it's a good money after bad money only.
I mean, I am, for example, right now I have a practical situation where one of my companies is actually doing well, and the founder has done well till now, but he has been slightly inefficient on burn, right? So he's done good growth, but the growth to burn ratio is slightly higher on the higher side. Now, at this point of time, we've already gone through the plan. They have to be more efficient. They have money for 12 months. But we are seeing that even in spite of COVID, their performance is doing well. So now at this point of time, the founder is asking, hey, like he's worried about the 12-month versus should he be worried about the top line growth? Because if he has found product market fit, should he be more aggressive? And there the big problem comes is that if you give a bridge right now, will he go back to the old way of inefficient growth?
Yeah, agree.
Right. So that is where it's become tricky.
Agree, Prayank.
Yeah, I think so. So just what I've tried to do in this particular situation is I'm trying to like what Anand said, sit down with the founder and talk a lot, but I'm not trying to wear him down. I'm trying to give him things to track. So I'm not telling him, okay, show me these metrics. You are not tracking these metrics. This is how I want your marketing efficiency to be reported. Let's see what has happened in the past. So just sitting down, enabling them a little bit, dikhao, and you yourself understand how you're doing yourself. And then why don't you go and ask these questions from other founders as to how they are performing. And then there is enough market data out in the market where others have written about what is their marketing ROI and all that. So just trying to show the mirror to the founder and see how he behaves.
No, Prayank, absolutely. Benchmarking and going deeper into the metrics and pointing out. I think it is important that founders understand that they don't stand very well. Some founders, for example, historically have said, oh, so and so company is burning much higher than us, for example, right? I mean, that's the very common excuse that we face from people. Like, we are doing so well because we're burning less, and so company is burning so much, right? And then you have to say, okay, you can't really play this through, and you can't create $1 billion company at these kind of metrics, right? And you take the question away from burn and say, okay, let's focus on the efficiency of the marketing dollar, the conversion funnel, the product improvement and retention and all of that. If you focus on those things, and there are benchmarks. Benchmarking is a very good exercise actually in these kind of things. I think any such discussion, typically for me in terms of negotiation, any bridge round or any follow-on round or any such discussion, typically has to happen after a detailed discussion on metrics only. Only then the founder is the right frame of mind to understand and take a deal and get going.
Absolutely.
Okay, let's move on, guys.
I'll run a little bit. Now we are getting into some of the tactical aspects of term sheets. So we can hopefully run a little faster. So in my experience, founder vesting is when at least first-time founders understand two very important things that they literally haven't thought through, even when they are actually chatting with investors, even when they get the term sheet the first time. They understand this the first time when they read the clause on founder vesting. One is that they can be fired from their own companies. It is, in my experience, it's a huge shock to founders that are running their companies for the first time. And second, that if they do get fired, they stand to lose a lot of their equity. Now, I would actually very strongly advise this group to be sensitive to the founders' anxieties on these counts. I mean, we tend to take things like founder vesting for granted, but for the founder, it comes as a huge shock. And in fact, very often they take what is a possibility into a statement of intent. So when you're in, I find that when I even am explaining this term of founder vesting, and then what happens in the case of resignation, what happens in the case they are let go, they take it as a statement of intent. Oh my God, this guy is telling me that he intends to let me go. That obviously is never the intent, but the founder doesn't know that. So both of these, I mean, I would very strongly advise the group to at least respect that sensitivity of the founder to these, huge and catastrophic events, even if they are unlikely. Second, I think it's very important in this clause to explain how this even works. In my experience, most founders actually don't even know how a founder can be fired. So they don't know that a CEO reports to a board. I mean, you can, and I'm talking of even people who have MBA degrees, haven't ever actually learned this basic fact that in any organization, the board appoints the CEO. And so they tend to, very often founders will tend to misunderstand and think that the investor or that particular partner who's on the board can fire me, and so he's my boss. And hey, I started my own company so that I don't need to have a boss. And all of those things come to mind. So sometimes I think it is important to even explain that basic fact that only a board can fire a founder, an investor cannot unilaterally fire a founder, and so on. Also, what happens in various scenarios, what happens in case the founder resigns, what happens, also why that term is in place. I would, especially in this term, I would shy away from saying this is standard and that is standard, because that reduces trust. Being able to explain various scenarios in detail, that this is what happens. We are trying to protect the company against the scenario where you leave or the founder leaves, and these are the other scenarios. This is what happens if you're let go. This is what happens if you commit a fraud, and so on. I think that both puts the founder at ease and also builds trust that you are actually explaining every scenario and not just taking the scenario where the founder leaves by himself or herself. I think it's also very important to recognize what the founder has already built, and this often translates into sort of pre-vested stock. If we are valuing the company at a certain value, and especially if they have actually built the company to a certain degree, then it's important to vest some of the stock upfront to recognize what they have already done. There is a
Ritesh, at this point, I just want to discuss how much you guys think in terms of pre-vesting the stock, and how do you decide how much pre-vested stock? Because that becomes a very key point for a lot of founders, right? And you're right, how much you pre-vest the stock and what schedule you follow for the vesting of the founders, and do you do quarterly vesting, do you do annual vesting, do you do a monthly vesting? All those things play a lot on the mind of the founders. But yeah, the pre-vesting, that itself,
usually I'll tell you what I do, and there is no standard.
Yeah.
There is no if it's a completely new company where operations don't exist yet, or maybe the product exists but there are no customers and so on, then I find it hard to justify pre-vesting. In a seed or a Series A company where there are operations, you're writing a reasonable size check. I think 20 to 25% is what I've done in the past, pre-vesting of stock, depending on how much I believe has already been created.
Yeah.
In terms of the vesting period, just the easiest to do is whatever is the vesting period for employees. So 4 years seems to have caught on. Nobody has ever fought back on this matter. I have seen term sheets from other investors that have 5-year vesting as well, but we mostly do 4 years. There's no right answer. There is no logic for it, to be honest, but nobody has fought back on 4 years. What we do usually, which again we face very little resistance, is a 1-year cliff uh, and monthly or quarterly vesting after that. That also, the fact that it is monthly or quarterly gives more uh, confidence to the entrepreneur that if they will not get fired in the uh, 23rd month of vesting, so that just in order to save the stock. Um, the other thing that I see as a huge heartburn for founders is no cause termination. Prayank, I believe you had some thoughts on this. So first, maybe we should, Prayank, why don't you explain what is no cause versus for cause termination, and then why is it?
It's important to understand that all term sheets have a for cause termination. That if there is a cause for which founder is terminated, then all his invested shares will potentially go back to the company. Typically, that is the clause which I've seen, and like you have to understand how the founder looks at it. So obviously, the question is, what is cause? That's what the founders start asking. And what is cause is, I mean, the easiest ones to explain are things like, you do something wrong. So IP theft, or, you've done fraud inside the company, or, sexual harassment. Any of these things become cause. The trickiest one cause is basically performance. So, if you say that your performance was not up to scratch and that's why the founder is being fired from the company, which happens, by the way, and it's very difficult when you're signing a term sheet at seed stage to decide and tell what is the parameters of performance on which you are going to be. When you don't perform, you are fired. Like, if founder says, hey, I don't come into office for 12 hours a day, I come for 5 hours, but how are you going to judge my performance? So what is the subjective metric of performance? I think that becomes a very important discussion with the founders, and you have to sit down. And typically I have tended towards, if you are pushing a certain constraint on somebody else, there has to be a constraint on me as well as to qualifying that constraint. I like to put a situation where a board decided plan for performance of the company, or we will decide some milestones for the company. And if, to be honest, it's very difficult to execute the performance measurement for a founder. You have to do 360s for the founder every year. You have to define good OKRs as a board member. So it is a lot of work on the board members. And then even then, who decides? If there is only one investor, will he sign off to invest? So it's tricky. But I think I went through this very interesting exercise where the founder said, I agree with all the things that you have said. I don't worry too much about the performance because I know I'll perform and all of those things. Tell me one thing, what happens if there are insinuations or there's somebody, you fire me for cause because somebody said I did a wrong thing. How will you prove it? Because somebody says I did fraud, and you can do, fraud is probably easier to prove. You can just go through the books quickly. You can look at all the contracts. You can figure out something. IP theft, very difficult to prove, right? What if that you had a previous founders are essentially engineers. They will start a second company. They will think it is okay to reuse the code of the previous company, and then somebody from the previous company, another founder of the previous company, or let's say an investor of the previous company, can come and sue the company. Hey, you used IP of the previous company. And in this case, what do you do? Right? Because whatever you've developed in the company is now subject to IP theft, essentially. The special case is essentially sexual harassment cases, right? So where, how do you, and given the speed at which our courts prove or disprove things, suppose allegations happen, and in a knee-jerk reaction, a board fires the particular founder. And let's say 10 years later, it is proven that it was not actually a case with merit. The founder's life has been ruined. He has been ousted from the equity of the company. How would, if you were to put yourself in the shoes of the founder, how would you what will we do, right? As a good investor, as an investor who cares about all this, how do you make sure that the founders is well protected? I think that's a very tricky situation, because at that point of time, in such a criminal case, it has to be proven by the court, and for reputational risk of the company, you terminate the founder, take away the equity, and at that point, and you need the equity to get somebody else in the company if the company will survive without the founder, so that they are incentivized to run the company. So you need the equity as well. But then the founder has not contributed to the growth of the company. So it's a very tricky situation, right? And you have to come up with some smart structuring, and then obviously will the founder say, okay, 10 years later, whatever is the value, I should get at least some part of my equity at that value. So that's why I think the call, even though it's a very standard term, which is written out there for cause termination, all of this. But if you start thinking from the perspective of the founder, and that's why you have to indulge with the founders, or you have to not even indulge, you have to actually sit down with the founders and explain and understand their worries and pains to see what all things can go in their mind, right? And like Ritesh said, this is actually one of the most hotly debated, discussed section, and most clarifications are sought by the founders. And if you leave it, and this is, I think, an opportunity which is lost by a lot of investors to build trust with the founders, because they will say, you can talk to my legal team, or you can get a clarification from one of the guys, and this is what it is. And the lawyers are very clinical about it, right? And they will say, okay, what you are talking about, these things we haven't seen before, so but this is what is standard. Because for them, when the conversation gets tough, this is the typical answer. So this is I think all guys who negotiate term sheet with founders, this is a very, very crucial topic, and you should give them time to think through this.
Yeah, the one thing we put in our term sheets is to clearly state that performance related termination will not be treated as cause, because that is the risk we are taking with our equity, that the founder might not perform. We don't include any performance related issues in the definition of cause. This is relatively straightforward. Accelerate vesting at exit. In reality, this just creates a place where the founder can negotiate from with the incoming buyer. There is no skin off our back. It just helps the founder get a good bargaining position with the new buyer. And I think it's also important to mention.
Ritesh, I have seen in case of exits, I have seen 1 year holding period, like the founders can't quit the company after sale of the company for at least 1 year. Also.
No, absolutely. That's why I said it's just a starting position for a negotiation with the buyer of the company. That this is not enforceable at all, because the buyer dictates everything in this kind of a scenario. But it gives the founder a good place to start negotiations from. If we already say that the founder needs to hold something back, then that is the point from which he can start negotiating with the buyer. So I do think that accelerating investing at exit just puts the founder in a better place to negotiate. And last, I think it is important to specify that invested equity doesn't come back to the investor or doesn't go back into the general pool where every other shareholder benefits. We like to clearly put in the term sheets that invested equity goes into the ESOP pool, so that we remove that incentive for us to fire the founder, and it sends a signal to the founder that we are not going to fire them out of greed, which frankly I've never seen an investor do, but or even think about. But founders very, very often have this concern that they will fire me just to grab my equity, and they're often advised by lawyers who paint those kind of scenarios.
Sorry, so Ritesh, we have 10 minutes. I unfortunately have to go for another call after this. at 6:30. So I think can we jump to the negotiation slide? So guys, I'm sorry, a lot of stuff which is there in that slides is self-explanatory, and there's a lot of content written, for ROFR, ROFO, and anti-dilution, and you can a lot of stuff.
Better to skip those here.
Yeah, I think maybe since all of us are there, it might make sense for us to go directly to negotiations, because that I think is a very important topic.
Yeah. So actually the way we had thought we'll do this is Prayank and I will describe our respective negotiation styles, and Anand, Madhukar, please jump in. I personally use a relatively non-traditional negotiation style because of my belief that nobody ever got rich in venture by negotiating a good deal. Sorry, this is. I think the first principle I negotiate from is that one should not negotiate to win. It's not a game. The winner of the negotiation doesn't actually get anything extra. I also believe that one should actually not try to negotiate the best possible deal that one can get. Because let's face it, there are parts of the negotiation, there are parts of a term sheet process that are win-win, but most of the negotiation is actually a zero-sum game. And if you are getting the best deal, someone else is getting a less than good deal amongst the range of possibilities. So I aim to shoot for a deal that I can live with, as opposed to the best possible deal for my firm. The style that I use is actually very simple. It requires a lot of discipline and also a lot of trade-offs that you have to make upfront. But the style is very simple, which is that I make the absolute best offer that I can make, which is actually the worst offer for that we would be willing to live with. And then I just stick with it. That way, I don't have to second guess the founder. I don't ever have to think about, okay, maybe I could have gotten away with an even better deal. Maybe the other party would have accepted something else. I just make the very best offer that I could make. I know that I could have gotten away with a slightly better deal for myself, but I think it takes also an enormous discipline to execute, because mostly we don't actually know our own walkaway point. We think we know it, but we don't know whether we would have been willing to pay a slightly higher valuation. If let's say we say my walkaway point is $6 million pre-money, would we have really walked away if at $7 million? I don't know. So which is why it forces you to think upfront, this technique, and stay disciplined. Second, I think it takes a big emotional toll on us because the other party will test you. The other party will keep badgering you, and like Anand put it, will try to wear you down. And you risk coming across as a jerk. If you repeatedly say that this is indeed my best offer and I'll not move from this offer. And it's really only possible if it indeed is your best offer. The temptation to be a nice guy is very high and say, okay, I will move a little bit in order to close the deal. But then the entire credibility of this process depends on not moving from your offer, because it is indeed your best offer. I think the other downside of this approach, I'll just take one more minute, Prayank, before I pass over to you. The other downside of this approach is that people derive satisfaction from a successful bargain. People don't want to be put in this position that this is my best offer, take it or leave it. When they are able to get something extra, they derive more satisfaction So I like to think that an offer that a founder negotiated down from or negotiated up from 5 million to 6 million gives them more satisfaction than an offer which is 7 million, but where the investor doesn't actually move from his stated position. However, to me, these are trade-offs. The uh, the reason I like this is the two reasons I like this is because one, it allows you great peace of mind. If you don't win a deal with your best offer, you walk away happy that it was never meant to be. Uh, and second, it builds trust. Second, uh, you know, the it creates a great start to the relationship. You are actually guaranteed that if the deal happens, it's a deal that works for you and it works for the other party, and you build trust with the other party. So to me, even if you leave something on the table, uh, that trust alone is worth it. Um, I do, however, sorry, Prayank, I said 1 minute, but I'll take one more minute, which is that after a deal has been negotiated, I do like to give a little something at the end as a sort of sweetener or as a sort of goodwill exercise. That, hey, I said I'll not move, and I've not moved. We have shaken hands, but here's a little extra something. That to me counteracts the feeling of that I mentioned earlier of not being able to win that the other party gets. It doesn't work for everyone. My own partners don't believe in this way of negotiating, but it has worked for me. I just wanted to share the benefits of this and why it has worked for me.
Yeah, I think my 2 cents on that is this is one of the reasons why a lot of sorry, there's a lot of echo. So this particular negotiating style has its I mean, obviously it's a disciplined approach, but it has some demerits, especially in the Indian context, especially with first-time founders, is what I feel. I mean, it might work out very nicely, but what I feel is, founders, I mean, typically view most investors with distrust. And when they see that this is if you become slightly rigid on this is my best offer, don't take it, then the founder generally thinks that he's taking advantage of me, which Ritesh alluded to the fact that they want to negotiate, right? So I prefer the style where I know some things which are non-negotiable for me. So certain things, like I will just go and tell them this is what is non-negotiable for me upfront. And then the other things you want to negotiate or you want to understand, let's do that, right? So it does two things, at least in my mind. The process, one, it tells the other party that, these are non-negotiable, and I draw their attention to those facts and they ask, why is it non-negotiable? So I want them to ask that question. And then we spend time, and I take this opportunity to build some trust. Essentially, I see the moment you have decided to invest in the founder, you have, as a board member, as a seed investor, you have to start building trust with the founder, and every action you take, and negotiating a term sheet or putting a term sheet in front is a very large action. Every financing round is a time at which whatever you tell the founder, they will probably listen, and it will remain in their minds for 3 months. And if the company starts doing well, you'll have they will think that the value for the investor is the value of the investor is not really adding value. Then you have to do something again to reassert that trust and build up your importance. I'm saying you have to be very important, but at least help the founder in some way. So the term sheet negotiation is a very, very important trust building exercise at that point of time. And I think what ends up happening is that you build incremental trust, and they judge, right? So the way you negotiate a term sheet is also how you will end up reflecting in the board, how you deal with them in board meetings, how will you request them to do certain things which they might not like to do. They will always be, and the founder essentially starts learning how to work with you. So that's why each style I don't think any style is right or wrong. There are merits and demerits to every style. So Ritesh style says something about how he's going to be a board member, and there's a certain style which I am going to be a board member of. So I like to spend a lot of time sitting down with them, discussing each term first from our base term sheet. But see, the founders typically tend to all the time focus more on the valuations and ESOP, and how many board members they should have. Should they add 2 other family members to the board? Whereas I am trying, so at that time when I tell them these are the non-negotiable things, they think those are the important ones, because I have not discussed anything else with them other than the valuation. And then suddenly I move to the fact that, hey, this is non-negotiable for us. And then that's like we spend enough time on that, right? So they understand why those things are important. So I think it's a very different strategy. And to be honest, we haven't done a survey as to who negotiates in what way. There is obviously like a lot of people worry about the fact that if I give a valuation, like for most of the time, I never have an exploding term sheet that you have to sign within 24 hours and send it back to you, right? So I have the same principle. Maybe somebody else, if the founder went with another investor simply because they offered a much higher valuation, they did not respect me as an investor enough. I was not adding enough value, then I have to improve myself further. In hot deals, though, it becomes a challenging situation where you really want to do the deal desperately. Then you might as well just up the price and forget about optimizing for so you can win the deal. So I think that's my 2 cents on this.
Yeah, I just have one comment. I like what Ritesh said. Sometimes, we also use the term sheet, not necessarily term sheet, but also the agreement, to form a good relationship and positive relationship with the founder. Right? And sometimes letting a few things, small things go. And for example, the vesting period, if founders have, let's say, spent 4 years already in the business, want to do a slightly more generous vesting period, those kind of things, we let them go just so that the relationship is on the positive start, and you earn some goodwill with the founders, in terms of having a say on the board.
So guys, I have to leave. I have another call.
And sincere thanks for joining us here. We couldn't have done it without you and Ritesh.
I learned so much from you guys.
Absolutely, same here.
Same here, Prayank.
Same here. I think
Thank you.
we are the best students here. We are also the you.
You're the only ones who ask questions, so you better be the best students.
Ritesh, are we done? Bye, Prayank.
Yeah, I think we are done. I'm okay to stay for a few more minutes to answer questions.
Yeah. Let's take some questions.
I had one question regarding vesting situation. So I had one situation. Suppose there are 2 founders with 50% equity, and after 4 years, both vest their equity, and one founder leaves. Now you come in as an investor. So is this situation a deal breaker for you? Like, given the 50% equity is already vested, or how would you like to control that part? Or just want to know your thoughts on the situation.
Anand, you want to take it?
Yeah, we've rarely had this kind of situation, but we do come across this. And many times one founder goes and you let them go. I mean, you let them walk away with their vested equity. I think don't want to do any special penalty or anything. In a very rare instance, we might have given some extra ESOP to the remaining founder, but by and large, you have to let them go. It's a very disappointing thing. Mohit, in a 2 founder scenario, it is far more rare for a founder leaving. But in a 3 or 4 founder scenario, it's very common for a founder to leave, right? In the first 5 years. But 2 founder scenario, very rare. It will be disappointing. Probably it will happen in the first or second year, at which point, in fact, if it happens in the first year or second year, we typically try to, the company is not very highly valued or anything. We try to get the founder to not take away any equity. That's what I would like to do.
Anand, what I am seeing that in case of some highly contested deals, if there are 2 founders with 50% kind of a scenario, the investors also sometimes put a EOD clause if any of the founders actually leave before 1.5 2 years. So before the company building activity has done, and if there are two founders and they are very equally at 50%, then vesting is one part. It also turns out to be a default situation as well.
Yeah, that's a good idea. Jigar had a question, Ritesh.
1 second. I'll just
Example of sweeteners.
Sweeteners. Sometimes it is valuation itself. So I have been saying all along that it's $6 million and we have agreed on 6. Then I'll go back and say, usually I don't do this because it reduces the credibility of that, but once in a while I have done that. Often it will be, if there has been a fight on the ESOP, if the other party has asked, नहीं 15% ESOP नहीं करना है, 12% कर लेते हैं, 10% कर लेते हैं, give on that. Basically something that the founder had asked for, but they had agreed to not get, and then you give it to them. At the end, it does build some goodwill.
Yeah,
so about that sort of thing.
ESOP and vesting period are two things that we have done. In some cases for legal fees, for example, right? I mean, anyway, it's on actuals, so we reduce the limit sometimes.
Okay, there seems to be one more question.
Just wanted to understand on the negotiation tactic that you were talking about. When a founder, when you actually
Sorry, was that Vikram speaking? At least I can't hear you anymore, Vikram. Okay, we'll come back to Vikram once he's back online. Any other questions till then?
Okay, guys, I think we should wrap up. Okay, Kunal Falak has a question on valuation. How much flexible should one be? For example, if you start with 8 million, do you end up at 12 million? That's a big distance, right?
Yeah, usme at least my style, like I mentioned, is to not move on it at all. If I think that I can afford a 12 million valuation, I'll make the 12 million offer upfront. I know that the founder might have agreed even to 8 million, but I feel dishonest saying, if I could have done 8, why did I not make if I could have done 12, why did I not make that offer upfront? So it's more a matter of style. My own, like I said, is to start with the best offer right up front.
So
and then not move.
That's a good strategy. Kunal, what we do is we start with a ownership in mind, right? And we are flexible on the money we want to put. So in this case, for example, if the idea was to own 20% with a $2 million check, probably the partner who's negotiating, he'll say, okay, I am flexible to go up to 2.5 million. And to that extent, the pre-money could inch up from 8 million to 10 million. But what we don't like to do is negotiate a lot. Maybe from 20, you are okay to come down to 19% ownership, but you'll not budge a lot on the ownership that you decided to acquire. So 20% increment is, we've found it to be common here. I mean, Ritesh, I know what you're saying, but sometimes, because we work at the early stage and typically the round size is like 1.5 million, sometimes you end up giving 250K, maybe even 500K extra to the founder. And yeah, I mean, the compromise on the equity ownership will probably be much lesser. Maybe sometimes no compromise. But in terms of the amount, little bit flexibility happens sometimes. Raghav Syal has a question on participating liquidation preference. Is this common? We don't see that much now, right? Nowadays, it's gone away.
Yeah, I've not seen it for a while. And frankly, for early stage investors, it doesn't even make sense. Yeah. For late stage investors, I sort of understand that it adds that extra punch to their, if you are going to make a 3x, you suddenly make 4x.
Yeah.
It's a meaningful difference. हमारे में ये होता है कि या तो 15x बनता है या कुछ बनता ही नहीं है.
If you want 15-20x, then 60 to 21x is not necessarily. It still is a bad taste. And so I think the last such liquidation participatory liquidation preference deal I saw was before 2014, but last 6 years I haven't seen that.
No, Anand, I saw in 2018. So
you saw it. It wasn't accepted, right? Finally.
Accepted, not accepted. It was there somewhere.
Yeah. That way, yeah.
And I'm back. That other meeting guy got cancelled because I joined a little late.
Thank you. Welcome. Yeah. You couldn't stay away.
I have seen these. It's amazing. No, or kya karna? This is like great. I wish when I was an associate, somebody had given me these lectures. So I have seen this in a lot of Series C's, by the way, a lot of times.
And it makes sense. Yeah.
And then we just negotiate them to non-participating.
Yeah. On that question, there is a recent practice of instead of a stacked cap table, everybody is at par. All the preferred equity are at par, right? Pari passu. What's the general practice? Is it like more pari passu nowadays? Or is it still like, Series C is priority over Series B is priority over Series A, which is priority over common?
So Anand, what I'm seeing is certainly more pari passu than before.
Okay.
But it's probably more 50-50 roughly. Earlier it used to be, it was very rare for Series C investors to agree to pari passu. Yeah. Now many of them are agreeing.
Yeah.
But of course the important thing there is that the seed and the A and the B have to be pari passu from before. So if your A investor is greedy and says, I need to exit before the seed does, which makes no sense at all. Yeah. If there's enough money for the A investor, if there's enough money for the A investor, there's going to be enough for seed as well.
No, I think typically the amounts are like $1 million, $5 million, $15 million.
Exactly. So what I'm trying to say is that if the precedent that you built in seed and A and B is pari passu, then it is more likely that the investor will also agree to a pari passu.
Very good point, Ritesh. I think this is what Madhukar and I have started doing, that we start giving pari passu to even angels, even the seed round, right? And because that's the whole idea, to build that expectation and continue all these good practices going forward, right? Instead of trying to be greedy in the seed or Series A stage. Right? So some of these, in fact, setting up precedences is a very good thing. For example, not doing participatory liquidation preference, not doing 2x liquidation preference, not having, for example, full ratchet anti-dilution, these kind of things. If you don't set up in the beginning, they will be continued, right? Because the founder will have enough muscle to argue to maintain status quo.
Prayank, I have one question for you, because your firm does a lot of deals. I have been seeing a lot of MFN clauses in Series A, and so why have they suddenly cropped up, and why will somebody ask for it, and why will somebody give it?
Yeah, so why somebody will ask for it is obviously very straightforward. I think the simplest answer is, let's say I have a 1x non-participating liquidation preference, and Series C guy comes in and puts a 3x liquidation preference and participating in, and I have MFN. So MFN, by the way, guys, is if somebody else after my investment in following round gets better terms than me, I will get all the same terms for all the analysts.
It's a diplomacy term called most favored nation.
Most favored nation. And so that is why people would like to have the MFN, that anybody else gets higher liquidation preference, higher, all of that. That's why people want it. And we never give it. Or if the person is stuck on MFN, we will never sign it.
The question is that who is giving it? Who is giving it? Because I have not seen this pass through any term sheet, and I must have seen like 10, 12 term sheets where this has come. So
we have received term sheets. We have, in our following, in our companies, we have seen term sheets where people have asked for MFN clauses, and we negotiate extremely hard on those. We never like to give it. And it's all about setting the precedents.
Yeah. Right. I think MFN clause given to early investors can actually hurt further financing, because, these people will not participate and yet insist on the MFN, right?
Anand, not only that, it actually goes against the philosophy of equity investment, right? Because the pricing of the company is done at one point of time, right? So in the subsequent round, if somebody is paying 3 times, if somebody is asking for a 3x liquidation, either he is paying that kind of valuation or the company is shit, right? So either of those cases, right? So therefore, the early investors definitely don't need to get paired with that.
Yeah. I think another point, Ritesh and Prayank, we can talk about is special care in term sheets when strategic investors enter. The term sheet. What would you be especially cautious about in terms of veto rights, etc., etc., particularly control rights, sometimes even economic rights, sometimes decision rights, sometimes for example, the ability to thought of a follow-on round. What all will you be careful? Which clauses will you be careful about?
Yeah, so I think so. We had actually a slide on ROFO ROFO. So see, almost all strategic guys want to have a ROFR, which is the right of first refusal. So to give you an example, let's say you are Rebel Foods, Fasos, and you're negotiating with Swiggy to get money from Swiggy. Swiggy will obviously want that you don't take any money or do any business with Zomato because they're direct competitor.
Yeah.
Right. So, or let's say in this hypothetical, or for example, you have some strong AI which Google wants to use or invest in you. They will want you don't go and sell it to Microsoft, or you don't partner with Amazon and other like. So in these cases, basically strategic guys go in for a ROFR. And what happens is they are basically saying if you get any other offers, we have the right of first refusal, because strategics come in with typically a mindset for acquiring a company. So normally strategics invest in a company assuming that they like the product and they might end up acquiring the business. And in that case, they want to acquire at a lower valuation. So, and what they don't want to do though is they don't want to do like the owners of price discovery by themselves, because whatever price they give, what if the price was too high and they bought it at expensive? So they find, so ROFR is a way in which the existing investor allows for price discovery from outside. And what will happen is, because the new incoming investor, once they see the term sheet, they'll say whatever offer I give, the other guy can match that offer and just invest. So they will give a lower valuation. So it essentially creates a lot of issues for the company. So we negotiate at least our firm negotiates hard with strategics at the ROFR terminology, unless on ROFR, unless it's value accretive or there is no other option.
I think, Prayank, we encountered a similar ROFR issue in one of our companies, and we finally had to walk away from the deal.
Yeah.
They said in the term sheet that we don't want a ROFR, but they tried to insert the ROFR back in some form or the other in the final agreement, and we had to walk away. It was like 6 months wasted on the whole process.
No, I agree. So a lot of times strategics do this. They will not get a ROFR. So they'll say, okay, we want to have control rights.
Correct.
On who you can do business with, for example. Correct. Right. So the typical control right, you can't do business with my competitor, or they will come up with a list of 15, 20 different competitors.
Yeah. Okay, guys. I think what we'll do is any more questions?
Yeah. So Ritesh, can you hear me now? Vikram. Yeah. So wanted to understand, this might be a little more subjective to the negotiation tactic that you were talking about. At least I've seen in a couple of early stage deals, the mindset is such that the first deal that is offered to either a intermediary like a banker or an early stage company is already at a premium. So they come in with the mindset that the first deal in itself is a little higher or not necessarily the best deal that they can get out of this situation. So how do you sort of safeguard against that? Is there a way to safeguard against that as well?
By telling them upfront and then sticking with it.
Yeah, over a period of time, reputation builds. Especially intermediaries learn and typecast companies. They understand that when they're talking to Prayank at Accel, he works in a particular manner. So, and your reputation builds. Or Accel does these kind of term sheets, because the banker would have seen those term sheets in the past. So,
right.
Similarly, works with
one of the things I have found useful is that I actually advertise that I negotiate this way. so that they know that I'm not faking it just in that negotiation. And, it is something that people can reference with existing entrepreneurs in our portfolio. And so that's why I said that in these kind of scenarios, it's important to be extremely consistent, not to actually take advantage of an entrepreneur who believes you, and actually follow it every single time. If you do, then that reputation builds that this person gives fair term sheets, or that this person is open to negotiating a lot, which whatever is the style that you want to, or whatever is the strategy of negotiation that you want, that you want to cultivate. I think it is important to be both consistent and also let the world know that this is how you do it.
Yeah. No, absolutely. I think consistency will build reputation, and reputation is important to be for the negotiation. One of the simple tactics that we used is that simply we published our term sheet on the website, right? I mean, and say, okay, I can't help it. It's there on the website. I can't change from it, right?
One of the interesting, by the way, nobody asked this question, but I had in one of the term sheet negotiations, I saw a very interesting delaying tactic. So delaying tactic meaning, they were, for example, either their diligence was not complete, or they were not sure of the fund closing, and they threw in certain things inside the term sheet, which incentivized the founder to go back and negotiate with existing investors. So I'll give you an example. So for example, the term sheet said, this is the round valuation, but we appreciate the fact that the founders have done a lot of hard work. So they will have the founders will have a differential equity at which they will get money, and existing investors will have to invest at a differential equity. And I'm like, this is like, what are you talking? And then second one was, if the founders perform, so inside the term sheet, the best way to delay a term sheet is you put in something which the founder really wants. Something like, we will give you a performance bonus. I'm signing on the term sheet that you will get extra equity in 2 years if you do these kind of numbers, right? And then no founder makes a 3-year or 5-year plan, and you say 3 saal ke baad, if your company is like this, then this is all. And then the founder will go into this negotiation. Let me planning, let me come back, and let me talk to my existing investor. It's a very interesting tactic I've seen. It essentially delayed one of our term sheet negotiations by roughly 1.5 to 2 months.
I think one practice which we, at least I use in early stage, I thought just go and ask the founder what valuation he wants, right? And if he says a number which I don't want, which is outrageously high, I basically say, yaar, to nahi ho payega, tu kahin aur chala ja, right? And if it is possible, then I just tell him ki this is what I can do, right? And with that, there only you try to build the trust, and then eventually you also tell the strategy, what you are thinking about, how much you want to own, how much you want to invest now, and what you will do in the future rounds, and so on and so forth, which basically correlates with your fund size, etc. And I have seen that if you are able to do that, post that the negotiations generally then come not in the term sheet but in the agreements when they have a lawyer. So the term sheet goes very smoothly, and thanks to Anand, we have kind of made our term sheet very, very simple, right? So most of the legal terms we have taken out and we have made it very simple. But when it goes to documentation and when the lawyer gets involved, then it takes some time. We are trying to bypass that also, but when there are more investors involved, then it is difficult to bypass. But if we are alone, then we sometimes use standard agreements as well.
So are there more questions? Otherwise, if you leave, so what we know is if you leave 4 partners in a room, then they can talk to them.
They can keep talking, right? Yeah.
We keep talking to each other only.
So guys, let's switch on the video. Apurva suggested we should take a screenshot.
Yes, please.
But yeah, I think some of us are running away instead of putting the video on. It was okay.
Gallery view. Yes. Finally, I get to see who all have been listening to.
Okay. Super.
What do you mean listening?
यार podcast की तरह listen करते हैं, I'm assuming.
Great, guys. Good to see all of you.